I'm Mary Ellen Stanek, Chief Investment Officer of Baird Advisors, and joining me today is Abhi Polankanti and Andy O'Connell for a discussion about the credit strategy today. You two have lived through in, a reasonable amount of time, but two historic market environments. So let's talk about 2020. A lot of firsts and a lot of worsts. So going into the early part of 2020, what was the credit strategy like?
Looking at 2020 and really in the back half of 2019, we remained fairly constructive on credit fundamentals overall, and that's something that's always key for us going look at first. And while that piece of it we thought was strong, credit valuations after spreads had tightened over the course of 2019 and really through the first part of 2020, valuations were getting much more unattractive. So we actually let our exposure to credit roll down, really evolve over time over the last 18 months, preceding the volatility we saw in March. And that really set us up quite well, going into the volatility in 2020. We had gotten probably to the lowest point of credit exposure, in this long cycle, which, over a decade long in going, but it positioned us well, and we had a lot of dry powder to take advantage of some of the volatility that we saw in March and beyond.
So what was it like? Go back to the middle of March when you talked about working side by side for your careers, and then one day we had to say we're going to split the key investment talent up. What was that like then in the middle of March, where you had to go stand up, be in different pods, working pods, and then start working through historic dislocation?
So what we saw in March was we saw significant stress in the corporate credit markets, the most stress we ever seen since the global financial crisis. We saw these lockdowns that were put in place, putting effect on the company financials, fundamentals. We saw expectation for GDP was significantly down. We saw significant stress in the markets. We saw companies were tapping the credit lines because they're not able to fund in the markets, or there was a funding stress. We saw significant dislocation. We saw indiscriminate selling by investors in the bond markets, creating a significant macro volatility on an intraday basis. Because of that, we saw a lot of companies drawing down on the liquidity lines that were put in place for funding. And then the Fed had to step in because of what we saw on these markets going on. The Fed injected massive amount of liquidity. On top of that, we have seen the fiscal stimulus provided by the Congress in the US and also the governments all around the world to normalize the credit markets. So those measures that were put in place helped to normalize the markets, and we have seen slowly some companies issuing bonds in the markets. Initially, we saw high-quality companies coming to the markets, and as markets normalize, we have seen more companies coming to the bond markets.
So even though Abhi and I were in physically different places at the time, that those years of experience together, not just the two of us, but with the broader team, is really helpful. We rely a lot on communication, and that's a key piece of how we invest. But even though we were in different spots, to know how we were thinking and to develop our communication strategies in a slightly different way, was important because we wanted to remain nimble and active, during a period like that. So it was different. When I went down to a different floor on March 16th, we didn't know how long. It's still been some time, and we don't know when the end is. But it's good knowing that we have the working relationship and the communication that we do, so that we can continue to do our best work for investors.
Talk about what makes Baird Advisors credit analysts different than other shops.
So we are a holistic approach. As a credit analyst, I spend most of the time doing my fundamental credit work, but I also participate in different parts of the businesses like portfolio management, trading, client meetings. So by participating in other parts of the businesses, it makes me a well-rounded credit professional. And also the flat structure we have, I think it's a very, very advantageous and very unique.
As Abhi has mentioned, we do, have a lot of responsibilities, but it's good because it gives you a full picture. Being able to speak with clients on a quarterly update, particularly after a market experience like this, explain what's happening, why we think, patience is going to be rewarded to hold on to credit during that volatility. But having those conversations with client really helps complete the loop, for what we're doing. One other piece, we've talked about is the duration neutral strategy that Baird has with our portfolios. At a previous shop, we weren't duration neutral, and at times, if you're on the wrong side of a duration move, it can be emotionally draining when we're, on the credit team is, scrapping for every basis point that you can get. By being duration neutral, it really allows what we're doing on a day-to-day basis, the research, buying bonds, building portfolios. It helps bring that to life, and removes some of that unpredictable volatility from having a duration call on.
Yeah, and the unnecessary stress. The other thing that makes us different is we pay everybody. All the incentives are driven on how the investor does, not just based on the credit picks or just what the muni team's adding or distracting from the portfolio or the structured. Talk about that.
That's not the sole motivation, obviously, why we're doing things, but it eliminates, a reason for potential competition or stress where there's stress on the investment team. Right now, we all row together. We all have one goal, and that's really helpful, particularly when you do see dislocations like that, because then it's all about finding the best opportunity. It's about finding the next best idea. So by removing some of that, we have a great allocation or collaboration amongst the team to go find that, and it makes the team stronger, and it's a reward for the client for sure.
Obviously, the year's not over yet. We got a few more chapters to write in 2020, and then on to 2021. And as you guys alluded, it's been a round trip for some credits where they widened a lot and then have come back in thanks to all the stimulus. But as you look at the portfolios, and particularly the credit side, how are you thinking about positioning credit for the remainder of 2020 going into 2021?
For us, everything starts with credit fundamentals. That's really the building block of everything we do, and then layer on, our relative value on top of that. And, coming into this year, we were still constructive on credit, and particularly parts of the BBB segment of the market, which we thought provided some opportunity. As we went through the crisis, in some ways, it was very positive to see that we held the belief that there's very strong incentive for investment grade companies to remain investment grade. And what we saw from companies almost across the board was that they took, very significant actions to try to remain investment grade. So it was a bit rewarding to see some of that play through, where we saw companies reduce their dividend or eliminate share repurchases, reduce capital expenditures, all music to our ears as bondholders, and help shore up the balance sheet and liquidity. So we thought all those actions were very prudent to issue debt in the period, improve liquidity, but now going forward, we acknowledge there are some risks that are higher. Uncertainty, is high, but we were pleased so far with what companies have done, and now it's going to be going forward, making sure that they continue that going forward.
So given the fundamental backdrop Andy mentioned, the technical picture has been also very positive for the US bond markets. We have seen a significant amount of money coming into the bond markets, be it like domestic investors or foreign investors, just because the credit markets are very strong last few months with the spreads tightening and the total returns being very positive. We saw a lot of retail money coming into the fixed income space. We solely invest based on fundamentals, but we also take a look at the technicals, because the technical valuations can persist for some time and it can have effect on the valuations. The technicals are very, very strong, very favorable. We have also seen a lot of issuance in the first 6 months of this year. The expectation is the supply is going to be down quite a bit in the second half. Given that with the strong supply-demand picture and with the Fed involvement, we expect the spreads can stay like this or maybe grind tighter by this end of this year. But given that, like where we are seeing the fundamentals and valuations, we will pay down some of the exposure into credit as it rolls down, as we don't think if the fundamentals are not justified with the valuations.
We're not getting paid for the risk. Thank you. We are really blessed to have you on the team. You're great partners. The future is extremely bright.
Well, thank you.
Thank you.